Hello and welcome back to Coinscrum Markets. I'm delighted to be joined today by Chris Bendiksen, Head of Research at CoinShares. Hi, Chris.
Paul, how you doing?
Good to have you back on the show. So, everyone's eyes have been glued to charts recently, looking at price going to moon. But in the background, Bitcoin mining has been chugging along as well, become quite profitable again for miners after, for those that survived the last bear market. So I thought it'd be a good opportunity just to take a look at the state of Bitcoin mining, where it is now, maybe look back a little bit at the last kind of hype cycle in 2017, mistakes made then, lessons learned then, are we entering a similar phase, that kind of stuff.
Absolutely.
So for those of you who don't know, Chris has been one of the most active researchers in the mining space as head of research at CoinShares, as I said. Very much looking forward to hearing Chris's views. Just for a high-level overview of some of the statistics as they stand today relating to the Bitcoin network and mining. We've recently made an all-time high in terms of the hash rate being applied to the network. Recently hitting a number around 165 exahashes on a 2-week average basis. The estimated power draw, and these are courtesy of the guys at Bituda over in New York who are publishing some excellent data around Bitcoin mining. Their most recent estimate is that we're around, the network itself is drawing around 9.6 gigawatts of power. To put that into context, the UK draws 44 gigawatts of power, so not an insignificant number. In terms of geographical distribution, China is still very dominant with an estimated 50% of the hash rate, but that has been falling slowly over the last few years. And in the US, where there has been an uptick and a lot of attention, the estimate is there's around 14% of hash rate currently operating in the US. So with all these things in mind, maybe, we, as I said, look back at 2017 and that cycle. Do you want to just kind of touch on that and maybe kind of tell our audience what happened then, and then we'll discuss where we may be heading now?
Yeah. So thank you for having me today. I think what happened back then is pretty much mirroring what is going on right now. And it's quite interesting because 2017 was kind of our first full industrial ASIC cycle tied to the price. And we're still in that era. Nothing much has changed other than scale. So I think it's kind of the same dynamics that are taking place right now. And so what we're seeing is that we have a price run up that is much more nimble than the run-up in hash rate can be, for reasons of price can go up very quickly. Hash rate can only go up as and when people get their hands on gear and deploy it, which has a multi-month lead time and requires a lot of capital. So I think we're kind of seeing the same thing right now. Price is outrunning the hash rate. And hash rate probably won't catch up for quite some time now. If this run-up continues, I think we'll probably end up seeing something similar in that mining becomes uber profitable for probably the remainder of this year. And that hash rate probably won't catch up with the price until after we have like a bit of a blow off top in this price cycle and price comes down again. And then the question is, will the same thing happen as last time, where we sort of had this minor capitulation that happened at sort of the final 2/3 of the price bear market, where the hash rate finally caught up with the price. The difficulty brought mining cost up to price levels, and there was a bit of a shakeout. So the big question is that going to repeat? Maybe. Wouldn't surprise me, especially if it repeated at least among some lesser experienced participants in the mining space. But I do think that because we've had a full industrial cycle of this beforehand, we're likely for at least a bunch of the experienced players to have learned their lessons. I also think that there's much more ability now for large professional miners to use financial products to hedge themselves and not end up, naked when the tide comes out. So.
Yeah, I think we'll touch on a few of those deeper into the conversation. And I guess, a couple of the things you touched upon there, and we'll see how they pan out. But I guess two factors in play right now, I guess, is during that previous cycle, we saw that power draw effectively grow during that cycle from around 2 gigawatts up to 8 gigawatts. So not insignificant, 6 gigawatts of power coming online. This time with, hash rate being a direct function of the price of Bitcoin, the more profitable it is, the more miners you're going to attract onto the network. It's quite feasible that if, even if Bitcoin blows out in another bubble and then corrects significantly again, but, forms a base at a higher level, say where we are now, that that demand or future demand of power could increase quite significantly to maybe 30, 40 gigawatts, which is in nominal value a much bigger step and a much harder challenge to finance that growth and the time it takes to get that online. So I guess that's one factor. And one of the other factors which we're seeing now, which seems to be unique versus back then, is there seems to be some serious supply strains from the manufacturers in terms of getting this new hardware. Lead times for new hardware from the three main manufacturers are like 6 to 8 months at the moment, obviously with huge demand. And just the way that the chip design has improved over the last few years, those manufacturers are competing for fabrication space with the rest of the compute industry.
Yeah.
So what do you think that's going to mean?
Yeah, that's a great question. I think, even though the percentage increase we might see in the amount of gigawatts deployed and the amount of hardware deployed, it will probably be somewhat similar this time around. The nominal amount is quite different. And while you could probably go around the world and find 5-10 gigawatts available at prices that are palatable to Bitcoin miners, it's a bit of an unanswered question if you could go out and find 30 more at similar prices. And like you're saying, last time the amount of hardware that needed to be built wasn't so large that it had like material impacts on the queues at the foundries, and now it does. Not just that, but last time around we were on a 16 nanometer process, and now we're on the 5 nanometer to 7 nanometer process, which means that, like you said, your competitors are the Apples and the Samsungs of this world, who are making this latest state-of-the-art handheld devices and computers. So it's not that easy to squeeze your way into that fab queue. So the question is, are we gonna end up with a multi-year lag on hardware post-price? And I think that is looking pretty likely. Everyone is absolutely sold out. Like, I'm hearing that, manufacturers won't even pick up the phone for certain people. So I think that could be the case. And that was, we kind of had the same dynamic last time, but I don't think it was for the same reason. Last time it was more of, the companies were actually needing to grow up to the proper industrial scale, but I would say that they're probably close to already being there in those terms. I feel like the manufacturing capacity that they have can be scaled up this time around. It's just a question of, can you get your silicon? Can you? I don't know. Doesn't look like it.
It'd be interesting to see. I mean, up until now, I guess the lack of competition in producing ASICs has been a key factor, which has given a lot of the power to the manufacturers. As we saw in the last cycle, I guess they took the approach of making hay and pushed prices up at the gate because demand was there, although that possibly wasn't best business practice, in the sense that they were pretty much likely forcing or knowingly going to be forcing some of their clients out of business quite soon for overcharging them. We're seeing the same again. Manufacturers have been putting their prices up, but I guess in terms of risk mitigation, maybe because these supply constraints are real, that will mitigate some of the risk for people, that are kind of agreeing to pay those higher prices. But I guess that remains to be seen.
Yeah, I mean, it is a free market. So at the end of the day, if a client is willing to pay the price, then they're willing to pay the price. And jacking up prices is the only way that we can jack up production, because we have to increase the competitiveness of these hardware producers in the queue for silicon. A lot of them also, it seems like, have to prepay for their spots, which makes their financing challenging. And so, taking prepayment at high prices might be the only way that they manage to actually get deeper into that production queue. So
yeah, I guess so.
And I mean, it kind of goes back to what we were saying earlier too, is have lessons been learned? And I think for the most experienced players, for sure. And they are much more savvy now on their end in how they price this gear. And they're probably way better, or placing themselves way better for the long term than last time, because this time they actually have a full cycle to look back at and compare and contrast in terms, at least in percentage terms, of network growth versus price growth and where we might end up being. But new players, they could go head first into the same traps as before. I mean, if prices keep going up like this, all of a sudden retail mining might become a thing again, as it did at the last peak. And, people were paying thousands of dollars for S9s, and, they were selling for like 3K on eBay. That could be a thing as well. So yeah, definitely the chance of people getting hurt from overpaying in terms of what will end up being what they should have paid, if you will. And that's the challenge right now. How do you price these things? How do you price these things with a view of the future that actually holds? Those are two very different questions, and you have to get them both right.
Yeah. Well, because of the potential pent-up demand here, I guess one possibility is the likes of Samsung step in themselves and start producing their own ASICs, because demand warrants it now. The market was probably still too small for them back then. So I guess that's one possibility. And in terms of broader risk mitigation for people entering the market or existing players as well, I think one of the big differences, 2017, we were seeing, the big demand. S9s were the dominant mining rigs being bought by the market. But in late 2017, the market knew, or should have known, that they were pretty much approaching the end of their shelf life. We were due major upgrade in terms of the next generation of ASICs and their efficiency. And we saw a jump, just as that cycle was sort of winding down, that, the next generation hardware, we saw an efficiency jump in maybe 2 steps of well over 100%. And so, those efficiency jumps throughout the kind of, the history of mining has been the biggest risk, and where, manufacturers have really, held all of the cards. As you said, we're kind of now up to 5 nanometer chip design. Conversations about the next upgrades, we're maybe only looking at 10, 20, maybe 20% efficiency increase. So I guess for miners and investors coming into the space, that is a big mitigation of risk versus the previous cycle.
Yeah, for sure. The fight against difficulty is the perpetual bane of the miner, right? Increases in efficiency drives that quite heavily. It's also interesting, though, that right now, if you think about it, every S9 that works is probably plugged in.
Yeah.
So even though, a lot of people, me included, have been prophesizing the death of the S9 for years, right? That thing is, it's the AK-47 of mining. It just refuses to go away. And with prices where they are right now, I mean, they're profitable in even in mining terms, modest uh, electricity cost regions.
Mm-hmm.
So there's something to be said for playing that game as well, and reselling and stocking. And if you go back a year, the S9 was unprofitable or rapidly becoming after having, they probably all went offline or went to price insensitive jurisdictions, or, the absolute bottom of the barrel electricity cost regions. But a lot of them probably went offline. And then, we entered this new bull market and they're profitable again. So there's something to be said for that too, and being able to predict and ride out these cycles. And that is a hard that is a hard thing to do, and a skill that I suspect only the more seasoned players are starting to acquire. So there, I think the main danger here is probably for fresh players coming in. I think we saw this last cycle too. People come in from commodities and figure, oh, I know, ore mining. So how different can this be? We'll get our way in here. We'll professionalize things. Like we'll set things up properly, and then you still kind of get screwed from the very unique characteristics of this industry. So I do think there's probably some danger from all of this, for being eaten up by the difficulty, from mistiming the cycle, all of these things that can eat up fresh players coming in. But I do think it's really only going to play into the hands of the more experienced players who are better at pricing, better at cycle positioning, who are probably going to just be waiting with open hands and, have pretty excellent, what is the word I'm looking for here? Balance sheets. Pretty excellent.
No, that's the right word, and that leads us in nicely, I guess, to other changes within the industry. Balance sheet is essential. It's a very capital intensive business. Previous cycles, early miners held Bitcoins, were easily able to finance themselves as the price ran up, and their balance sheet was there and increasing significantly because they were long Bitcoin. Not all of them followed that strategy, but it's obviously one that operators need to consider, and how they what their mix is in terms of divesting back to US dollars or retaining Bitcoins on their balance sheet in the long term, but riding out volatility. But I think the big difference we've seen this time is the introduction over the last year, especially of miner financing for financing of equipment and hardware. There's a few players coming to the market. DCG have launched a subsidiary called Foundry, which is financing miners, Blockfields in Chicago, BlockFi, Arctos on the West Coast. So obviously, that's an interesting product. Mining operators, would much prefer to be financing the hardware on debt rather than raising capital on an equity basis. So, what do you think that's going to do to the market? Again, alongside these supply constraints, I mean, there is an argument that if too much financing comes into the market at once, and there's a glut of supply, then no one knows who's doing what on the financing side. People could completely overextend, then the hash rate gets ahead of itself. People suddenly make themselves unprofitable by default. Where do you think we're at in that cycle?
Oh, that's the natural progression of economic cycles, though, I think. So I think we're probably at the foothills of that. This development of financing markets, particularly in the Western jurisdictions. I mean, we've seen to a certain extent, Bitmain doing this for a few years through Matrixport and similar ventures like that out east. But having a proper financing market develop in the West has been something that I've been really wanting to happen for quite a few years, because I think it's one of the the key drivers that, give the West sort of like an upper hand on the East. And I do really want to see more hash rate in Western jurisdictions because of stronger laws like a liberal shared order and protection and respect of private property. I think it's much less likely that we'll see any type of tomfoolery with other people's mining gear in our Western jurisdiction due to our much stronger laws and legal systems. And so these types of financing markets propping up now, I really hope is going to sort of give an edge to Western miners and bring more hash rate over to the side of the world. Now, can we do that with the silicon constriction that we have? I don't know. It's, we need a foundry.
Yep. Well, TBD. I guess Samsung have one coming online in the US, but not for another two or maybe 3 years. So that adds to the lag effect, and could keep things profitable for a long time if prices remain elevated. And I think just as alternative products come into the market, everyone's obviously with the rise of various proof of stake networks and DeFi in general, with lots of excitement about yield generating opportunities, especially under current interest rate environments in the broader economy. The incentives for people to offer capital to mining with the types of returns available, with yields of well over 10% available at the moment. That's going to be see how that pans out in terms of attracting more institutional capital. And you could argue that, in essence, that kind of makes Bitcoin look like proof of stake for the US dollar in terms of financing the hardware through US dollars and getting a yield on it. So I don't know, it's going to be an interesting one to watch. But I think, as you said, I think we've got a little bit of time, and the supply constraints are going to kind of prevent some excess lending into the market. You mentioned earlier about retail. The retail market again. In the last cycle, there was a big push on hash rate contracts, which were basically kind of enabled smaller customers to go beyond having to mine in themselves in their bedroom to take advantage of the economies of scale that a large data center provider could offer. And you could buy these contracts, which effectively bought you the right to a certain amount of hash power. But again, with mining, any kind of any rent that is added to the mix is a risk, because when things turn, we hit another downturn, kind of those guys are the heads on the block first. We've seen some, I guess, more innovation around that now. I guess again feeding back into DeFi with the introduction of some kind of tokenized hash rate contracts. I know Poolin, one of the large mining pool operators, has issued something. What's your thoughts on that? Is that just playing into retail market, but adding an unnecessary risk?
Well, I mean, I don't mind retail getting involved in whatever retail wants to get involved in. It's a free world as far as I'm concerned. This is notoriously difficult to price, right? And I think we've seen that over and over again with these types of cloud mining contracts in particular, is that people just aren't very good at pricing them. The structure hasn't always been the best. It's never even always been clear whether or not there actually is any physical hash rate on the other end, or whether or not it's like a bull market, pretty close to Ponzi style thing that's going on. Cloud mining contracts aren't very different from hash rate derivatives as we would like to see them in terms of larger scale, professionally or institutionally built products for larger miners to take advantage of to de-risk their exposure to difficulty. So I think letting retail be a part of the liquidity provision in that market is probably a good thing, because as we've discussed many, many times, the big question is like, who takes the other side of that contract has been like a large outstanding question. And, retail punters, they represent a pretty solid pool of liquidity out there. If they're interested in doing it, even if it's purely as like a speculative, YOLO bet, then, fine. It still achieves the same outcome for the miners that need to de-risk. So if they want to be a part of that, I think that's excellent. Do they need to be careful? Absolutely. Are they likely to get burned? Yeah. But you're also likely to get burnt when you go 100x YOLO long on BitMEX, and no one's going to stop you from doing that. So, be careful, don't be irresponsible, and like don't bet the farm and all that. But have at it. Like, go make some money if you can. If maybe you've figured things out. So I think retail liquidity is a solid part of the pool that needs to go into the other side of this. So all the power to them.
Absolutely, and I guess if hash rate does scale to what it quite likely could over the coming years, then the capital demand to finance all of that extra capacity is huge. So wherever it comes from, it comes from. And like any of these markets, there'll be some latecomers and there'll be people get burnt, but there are opportunities there as well. So it's another one, interesting one to watch. And maybe on the slightly more professional side, we're seeing the emergence, or have seen over the last year again, of like deliverable hash rate contracts for some of the larger mining operators to forward sell their hash rate as an alternative financing option to straight up debt financing. So
and these contracts they're not very conceptually different from what a cloud mining contract is, right? And so if we could merge those two markets, if you will, and make sure that the contracts are very solid and have some enforceableness to them, and actually represent physical hardware on the other end, which you kind of have to over time if you don't want to get bust. But we need this, right? We've been talking about it for a few years. It's just it seems like one of those things that just needs to grow like from the ground up. Like you can't engineer your way into it, or at least if you're going to do that, you need someone come in with a giant balance sheet that can like take on this type of risk. And
who's
going to do that?
So maybe a segue into the final question, I guess, or final couple of questions. Who has big balance sheets? Nation states have big balance sheets. And again, over the last year, are we seeing signs that is the next move as we go from a few gigawatts to tens of gigawatts? Over the summer, we saw Iran permit energy firms over there to mine Bitcoin, and then shortly after laid down the law that those same energy firms had to sell their Bitcoins to the central bank. So you've got these kind of macro geopolitical plays to watch out for, especially in terms of potential challenges to the dollar and companies which are under US sanctions, and looking at Bitcoin as just a way of bypassing sanctions. Other nations just with excess energy. Ukraine last week announced that they're potentially going to dedicate excess nuclear power to mining. In the former Russian states, there's a lot of activity. Kazakhstan, in Russia itself. So there's the nation state play, and then the other interesting one, I guess, which is going to emerge more. And again, maybe saw one of the first signs last year. Crusoe Energy, a mining operator out of the US that utilizes flared gas from oil fields to convert to electricity. They agreed a partnership with Equinor, the Norwegian energy firm, the former state-owned energy firm.
Still state.
Are we going to see energy companies come in and say, right, we should be doing this directly ourselves, and are we going to do it ourselves, or are we going to partner with the experts in the space?
Yeah, they're probably going to partner at least at first. I mean, it's funny. Equinor is still 66% owned by the Norwegian state. So the Norwegian state is now, deep into mining, which I find hilarious for how sort of weirdly they've been thinking about this space previously through some of the regulations. But yeah, I mean, what does the game theory tell us here? I think nation states are gonna get involved here. I mean, it just too good of an opportunity to pass on, which I think is exactly what's driving the Ukrainians in particular. And nuclear power is very interesting in that it's there. Well, this it's a typical Bitcoin mining region that they got going. This is in the still very heavily industrialized part of Ukraine, but used to be even more heavily industrialized. So you have like at least a partial deindustrialization happening, but you have this already built power capacity with excess like production capacity, and where the additional OPEX they have for burning or for creating more electricity isn't really much. So the sort of marginal cost they have of electricity creation is quite low because the gear is already in place. There's just no client. And I think mining as an opportunity is just going to be too good to pass on for a lot of these state-owned enterprises like this. The big question is like, what are they going to do with the coin? Are they going to take this on board as part of their reserves? I don't know if you heard Lagarde say that it was very unlikely that the ECB would have Bitcoin on their balance sheet in the short term. I was like, okay. Why are you answering that question? And interesting wording.
Yeah.
And I mean, honestly, do I think that's going to be a thing? Yeah, definitely. It's just a question of time. How many cycles does it take? I think we Bitcoiners tend to sort of overestimate the speed at which things tend to happen. 2017, everyone was crying for hyper Bitcoinization. I'm sure the same exact thing will happen this time. And I'm also pretty sure that this won't be it. How many cycles does it take? I think all of these things need to build on each other over time for this to actually become robust enough to be the large global future that we're hoping for. And all of these incremental steps that we're seeing play into that. It's no coincidence that that the states are going for the solution.
No, absolutely. And I guess maybe just to finish up, recently we've seen, CEOs of S&P 500 companies, publicly stating that they need to de-risk against the US dollar. And as we've just discussed, certain nation states might see this as an opportunity for, boosting their own balance sheet, for bypassing sanctions. And then at the same time, with the Chinese getting ahead of the game in terms of the digital yuan, as the first mover on like a central bank digital currency. Is this a two-pronged attack on the US dollar, which is just setting up to build? And again, in game theory terms, what does the US do?
Yeah, it's also a question of what has the US potentially already done. Who knows? What do they do? Hopefully they just let their tech-savvy population do what their tech-savvy population tends to do, which is be, ahead of the game a bit. So if you look at like where Bitcoin ownership is distributed on a worldwide level, American owners are heavily in there. So if the US government just lets their people do what the people do, which is in a distributed fashion, go out there and make their own decisions at the tip of the economy in terms of what is best for them. And if they just let them do that, I think the US will end up on top again, kind of annoyingly.
Yeah, I mean, and they do have some of the cheapest power rates in certain parts.
They do. Of the US. They do, and they have incredible capital markets and incredible potential for building out renewables in areas where there's pretty much no people, where you can just set up mining operations as either your financing or like your stepping stone before connecting to some grid. I think the opportunity is incredible in the US. I wish Norway, my own country, would like get their shit together a little bit and take the opportunity here. I mean, we're an enormous energy exporter. That's kind of what we do. Huge aluminum smelting industry, building these like multi-billion-dollar cables to the continent. We can build out our renewables infrastructure right now and monetize it on the spot instead. But they don't seem interested, which is weird. So yeah, I don't know. What does the US do in terms of the dollar? Let it die? I don't know.
Well, I think that's another thing that the market will decide on their behalf, maybe. Not without some fights, I'm sure. And I sense there's going to be quite a few international staring matches going on over the next few years. And we're just going to have to get you back from time to time and see who's blinking first.
Yeah, seriously.
Chris, as always, pleasure speaking to you. Thanks for your insights, and we will certainly get you back on soon.
Thank you, Paul. It's a pleasure.
Thank you.